Your phone buzzes at 7:43 in the morning. Not a text, not an email, a push notification from your bank. 2 words, account restricted. You put your coffee down. Your fingers move to the app almost on instinct, the way they always do when you check your balance before the kids wake up. But this time, the screen does not show a number. It shows a message, a very short, very cold message. Access to your account has been temporarily suspended, pending a compliance review. Please contact your financial institution. You read it again and again. Your stomach drops somewhere below the floor. You have $7,300 in that account. Your mortgage payment pre-authorizes in 4 days. Your car insurance comes out the day after that, and you have absolutely no idea what you did wrong. Welcome back to Canada Property Watch. In our last 2 investigations, we exposed how the CRA's automated data matching infrastructure is quietly cross-referencing your TFSA contribution history against your rental income declarations, and how the self-supply rule buried inside the Excise Tax Act is executing a wave of HST reassessments against home builders who never even knew they had a tax obligation. Today, we are going inside something different, something that feels more immediate, more physical. Because this one does not arrive as a reassessment notice in the mail. This one arrives as a wall that goes up between you and your own money, without warning, without a phone call, without a judge, and in most cases, without any requirement for the bank to tell you exactly why. Today, we are talking about Canadian bank account freezes in 2026. Once the 5 specific triggers that are causing financial institutions across this country to lock down personal and business accounts, and what the legal architecture behind that action actually looks like when you are standing on the wrong side of it. Before we go further, quick question for you. Do you have more than one account at the same bank, or do you split your money across different institutions? Drop A for same bank, B for multiple banks. I genuinely want to know, because it changes everything about what this video means for you. Let us start with something most Canadians fundamentally misunderstand about their bank account. They think of it as their property. It is not. Legally, when you deposit money into a Canadian chartered bank, you are making an unsecured loan to that institution. The money becomes the bank's asset. What you hold is a contractual right to demand it back, and that contractual right is governed by the terms and conditions you agreed to when you open the account, which almost nobody reads, combined with a sprawling federal regulatory framework that gives banks extraordinary powers to restrict your access when certain conditions are triggered. The Proceeds of Crime and Terrorist Financing Act, the Bank Act, FinTrack reporting obligations, and OSFI's supervisory guidelines together create a compliance environment where a bank's legal exposure for not freezing a suspicious account is, in many cases, far greater than any inconvenience caused to a customer. That asymmetry is critical. The bank is not freezing your account to punish you. The bank is freezing your account to protect itself from a regulator that has made very clear it will issue catastrophic fines for compliance failures. You are collateral damage in their regulatory survival calculus. Now let us get into the 5 triggers, and I want to be precise here, because this is not a general warning. These are specific, documented patterns that Canadian financial institutions are flagging in 2026 with far greater aggression than they were 3 years ago. Trigger 1 is structuring, not the kind of structuring you are picturing. Most people hear that word and think of organized crime, drug money, offshore accounts. That is not what is catching Canadians in 2026. What is catching ordinary property investors, small business owners, and even salaried employees is the accidental structuring pattern created by real estate activity. Here is how it happens. You sell a property, you receive a large sum. Instead of depositing it in one transaction, you move it around. Maybe you deposit part into your personal account, part into your spouse's account, part into a holding company. Maybe you do it across a few days because you are not sure how to handle it. Maybe you do it because your accountant told you to move funds before year end. It does not matter why you do it. What matters is the pattern. Canadian banks are required under federal law to report any cash transaction over $10,000, and they are also required to report suspicious transaction patterns that appear designed to avoid that threshold, even if each individual transaction is perfectly legal. The FINTRAC reporting obligation does not require proof of intent. It requires reasonable grounds to suspect. And in 2026, with machine learning tools running behavioral analysis across millions of accounts simultaneously, reasonable grounds to suspect is an extremely low bar to clear. Your account does not get frozen because a human being looked at your deposits and decided you were a criminal. Your account gets flagged by an algorithm, the flag triggers a compliance hold, and then a human reviews it after the fact. By the time any human eyes land on your file, your access is already gone. Trigger 2 is third-party payment anomalies connected to real estate. This one is exploding right now specifically because of what happened to the Canadian rental market over the past 3 years. Landlords who were collecting rent in cash or collecting rent through e-transfer from multiple different names at irregular intervals are now being caught in a net that was not designed for them but catches them anyway. Here is the mechanical reality. When your account receives e-transfer payments from 15 different names across a 30-day period, the bank's transaction monitoring system flags it as a high-volume third-party payment pattern. This pattern is also consistent with payment aggregation schemes, subletting fraud, and unlicensed payment facilitation. Your bank does not know you are a landlord. Your bank sees a behavioral fingerprint that matches a risk category, and it acts accordingly. The freeze goes up, the compliance review begins, and in many cases, the bank will simultaneously file a suspicious transaction report with FINTRAC, a report that you will never see, that you are legally prohibited from being told about, and that becomes part of a federal intelligence record attached to your name. This is not a hypothetical. The combination of rent pressure, the rise of short-term rental income, and the normalization of e-transfer rent collection has created a scenario where entirely law-abiding landlords are being swept into a compliance review process designed to catch money launderers. Stay with me, because what comes next is the trigger that nobody is talking about, and it is the one most likely to hit someone who has never done anything wrong in their life. Trigger 3 is credit profile mismatch following a significant asset event. This is the one that catches people after a home sale, an inheritance, or a legal settlement. You have lived your financial life at a certain income level. Your bank knows your patterns, monthly deposits of roughly the same amount, regular bill payments, a predictable rhythm. And then one day, a transfer of $400,000 lands in your account from a real estate transaction, or from an estate, or from an injury settlement. The bank's behavioral model has no context for this event. From a pure pattern recognition standpoint, a large, sudden, unexplained inflow into an account with a previously modest transaction history is one of the highest risk signals in financial crime typology. It matches the profile of a money mule, someone whose account is being used to layer illicit funds through the financial system. Your account is frozen while the bank attempts to verify the source of the funds. And this is where people make the situation catastrophically worse. They panic. They call the bank and demand answers. They try to move money to another account before the hold resolves. Every one of those actions registers as an additional risk signal. The more aggressively you push, the deeper the compliance review goes. The correct response, which almost nobody knows instinctively, is to immediately provide documentary evidence of the source of funds, the transaction that generated them, and ideally have your lawyer or notary contact the bank's compliance department directly. But most people do not know that. Most people experience the freeze as an attack and respond the way people respond to attacks, which makes everything worse. Quick point here, and I want you to think about this honestly. If a large sum landed in your account tomorrow through a home sale or anything else, do you have the documentation ready to prove where it came from? Drop me yes or me no in the comments. It will shape the next investigation we run. Trigger 4 is CRA, linked compliance flags, and jeopardy orders. This is where the bank freeze stops being a bank problem and becomes a federal enforcement problem. And the distinction matters enormously because the legal architecture is completely different. When the Canada Revenue Agency has reasonable grounds to believe that a tax debt is in jeopardy, meaning the agency believes you are about to move assets, leave the country, or transfer property to avoid collection, the CRA can apply to the federal court for what is called a jeopardy order. A jeopardy order authorizes the CRA to take immediate collection action without the standard 90-day waiting period that normally follows a tax assessment. One of the most powerful tools available under a jeopardy order is the requirement notice, a legal instrument that can be served directly on your bank, requiring the bank to freeze your account and remit whatever funds are held there directly to the CRA. You do not get advance notice. You do not get a hearing before it happens. The first time you know it has happened is when your card declines at a grocery store, or when your mortgage payment bounces. And unlike a standard bank compliance hold, which is theoretically temporary, or a CRA-driven account seizure under a jeopardy order can result in the permanent liquidation of everything in that account before you have even had the opportunity to dispute the underlying tax assessment. The practical consequence is devastating and absolute. People who have been reassessed for unreported rental income, denied principal residence exemptions on flipped properties, or flagged for business income inside a TFSA are increasingly finding themselves on the receiving end of this mechanism in 2026. The CRA's collections infrastructure has become dramatically more aggressive, and the jeopardy order, once a rarely used emergency tool, is now a standard instrument in the agency's enforcement arsenal against real estate-related tax evasion. Trigger 5 is the one that is most misunderstood, most underestimated, and in many ways most merciless. It is correspondent banking and international transfer flags. Canada's major banks do not operate in isolation. They operate within a global correspondent banking network, and that network has its own compliance architecture that sits entirely outside Canadian regulatory oversight. When you initiate or receive an international wire transfer, that transaction passes through one or more correspondent banks, each of which applies its own risk screening rules. If your transfer touches a jurisdiction flagged as high risk, if the counterparty's name appears on any sanctions list in any country the transaction routes through, or if the transaction amount and structure matches any pattern in the correspondent bank screening model, the funds can be frozen mid-transfer, not by your Canadian bank, by a bank in New York or London that you have never heard of and have no relationship with. And here's the brutal reality. Your Canadian bank cannot unfreeze those funds. Your Canadian bank cannot even see exactly why the funds were stopped. All they know is that the correspondent bank has placed a hold, and the resolution process can take weeks or months, requires documentation submitted in formats you may have no experience with, and may ultimately result in the funds being returned to the originating account rather than delivered to the destination, at which point the transaction has to be restructured entirely. For Canadians who purchase pre-construction properties using international investment funds, for those receiving rental income from foreign family members, and for immigrants who routinely transfer money between Canadian and foreign accounts, this trigger is not theoretical. It is happening at a frequency that is genuinely alarming. Now let us talk about what a freeze actually does to you in the real world, because the abstract legal mechanics are one thing, but the cascade of consequences is where the true destruction happens. Your mortgage payment bounces. Most lenders will give you a grace period of 15 days before reporting a missed payment to the credit bureau. That sounds like a lot of time. It is not, because your bank may take up to 10 business days to even acknowledge the hold, another 3 to 5 days to connect you with a compliance officer, and the documentation process for resolving a compliance review typically takes longer than the grace period provides. Your first missed mortgage payment drops your credit score. Your credit score dropping below certain thresholds can trigger a review clause in your mortgage contract, particularly if you have a HELOC attached. A HELOC review can result in a reduction of your available credit limit, which further constrains your liquidity during the period when you need access to emergency funds the most. This is not a linear problem. It is a non-linear cascade where each consequence makes the next consequence worse, faster. If you have a rental property and your rental income flows through the frozen account, your property management expenses, insurance premiums, and utility payments on that property all bounce simultaneously. Unpaid insurance on a rental property can trigger a default clause in your mortgage agreement. An insurance lapse on a property with tenants creates personal liability exposure. And if your property manager cannot access funds to pay the building's maintenance obligations, you may face regulatory action from the municipality, particularly in Ontario, where the Residential Tenancies Act creates strict landlord obligations that do not pause because your bank account is frozen. For incorporated small business owners, the consequences arrive even faster. Corporate accounts are subject to the same freeze triggers, but the downstream effects hit employees and suppliers immediately. Payroll does not process. Supplier invoices go unpaid. Contracts contain default clauses triggered by payment failure. A 2-week compliance hold on a corporate account can cause enough reputational and contractual damage to destroy a business relationship that took years to build. And here's the thing that makes this genuinely terrifying at a structural level. Banks are not required to compensate you for losses caused by a compliance hold that was later determined to be unjustified. If the freeze was imposed in good faith based on the bank's regulatory obligations, the bank's liability exposure is minimal. You can complain to the ombudsman for banking services and investments. You can hire a lawyer and attempt to pursue damages. But the practical reality is that the cost of litigation exceeds the losses in most cases, and the bank's legal teams are built specifically to absorb exactly this kind of challenge. So what does protection actually look like? Not financial advice, structural awareness. The accounts most resistant to freeze triggers are accounts with long transaction histories, consistent behavioral patterns, and documentation trails that contextualize unusual activity in advance. If you're about to receive a large sum, notifying your bank in writing before the deposit arrives, providing documentation of the transaction's source, and referencing the specific transaction in your notification creates a paper trail that interrupts the algorithmic flag before it triggers. Separation of personal and business cash flows is not optional risk management in 2026. It is the minimum structural requirement for anyone operating in the real estate space. The commingling of rental income, personal deposits, and business revenues in a single account is not just messy accounting. It is a behavioral fingerprint that matches multiple risk typologies simultaneously. The broader picture here is one that Canada Property Watch has been tracking across every investigation we have run this year. The infrastructure of financial enforcement in Canada has undergone a quiet but absolute transformation. The tools are more powerful, the algorithms are more sophisticated. The regulatory pressure on banks to file reports and freeze accounts is more intense. And the ordinary Canadian property owner, who spent the boom years operating in a system that looked the other way, is now operating in a system that cannot look away even if it wants to. The machine is running. And it does not distinguish between the sophisticated fraudster and the accidental pattern matcher. It just flags and freezes, and leaves the resolution to a process that is slow, opaque, and costly. You are watching this video right now because something in the title made your stomach tighten slightly. Pay attention to that feeling. It is telling you something useful. One final vote before you go. For our next investigation, we are looking at 2 angles. If you want us to go deeper on CRA jeopardy orders and exactly how they target real estate investors, vote jeopardy. If you want us to break down what happens when your mortgage renewal is denied due to a credit event caused by a freeze, vote renewal. Drop your vote below. It decides what we build next.